Rules are as important in investing as they are in life. Rules of good investing include buying good companies at a right price and staying invested without deviating from a set framework. It's impossible to be unbiased in our decision-making. However, we can reduce our biases by identifying and creating rules. With this in mind, we have introduced a rule-based fund that systematically follows investment rules tested over market cycles with minimum human biases. Now, let's take a closer look at how this rule-based model works. The model starts with BSE 200. It follows a three-step process. Step 1. Eliminates long-term detractors of alpha. Step 2. Selects durable sources of alpha. And Step 3. Assigns weights to achieve effective risk management. The elimination process scans companies for value-diminishing components like very high debt, excessive price volatility, inefficient capital allocators, etc., removing almost 80 to 100 companies at this stage. The ones that qualify move to the next step, which is selection. In the selection phase, durable sources of alpha include factors such as quality, value, and growth, which have demonstrated long-term excess returns across geographies and market cycles. The end result: the selection of approximately 50 good companies. These companies then move to the final stage, where appropriate weights are allocated. The weighing process ensures adequate diversification through stock and sector concentration limits and also addresses liquidity risk. We believe that this three-step model of investing is an efficient strategy that is designed to beat the benchmark using rational principles combined with scientific risk management. Introducing the DSP Quant Fund. Backtests show that the quant model consistently delivered returns in excess of the benchmark if evaluated over a 5-year period, because the model systematically follows rules and doesn't deviate from the framework. Another key advantage of this model is that it doesn't fall as much as the benchmark in bearish markets. Having said that, the model may underperform in certain periods, such as sharp rallies not backed by fundamentals or market reactions to policy changes. Therefore, we recommend investors to stay invested for a minimum period of 7 years. If you believe that rules rule, consider the DSP Quant Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.